From New York City, for our viewers worldwide, I'm Manus Cranny in for Jonathan Ferro. Here we are. We're cruising towards the fourth day of record highs, maybe in the S&P 500. Do you get vertigo up here, or do you buy protection? Countdown to the open begins right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up in the show, futures point to more record highs on the street. Netflix getting the tech earnings off to a solid start, and Donald Trump inches ever closer to that rematch with President Biden. We begin with a big issue, a critical 48 hours for markets.
Look at the data.
The data, GDP, etc., coming up.
PCE spending in the U.S.
GDP numbers, PCE numbers are going to be very important for the Fed outlook.
Everyone believes that the next move by the Fed is a cut.
The question is when and by how much.
We're in a soft landing right now.
Growth is going to likely to surprise us on the upside.
We see strong growth, and we see that there is a risk of reacceleration in growth.
We do expect growth to remain positive as we look further out into the new year.
Baseline, I think you still need the economy to cool to get the Fed to cut.
What gets them to cut in March is the inflation data.
Inflation's coming down. It's coming down decisively.
There could be this stickiness to inflation, which of course makes the Fed's intended path a bit more trying.
The more they wait, the harder it's going to be to cut rates.
They're going to be taking a read on that macro outlook to figure out when to cut rates.
Joining me now to debate when the rate cuts come, it is BlackRock's Gaji Chowdhury and JP Morgan's Jack Caffrey. Good morning. So let's talk about, can they extend? Can they wait? Can they wait until the summer to cut rates? Let's start that conversation with you, Jack.
You know, I certainly think that you've seen a dramatic repricing of the expectations of whether we're going to get that cut in March. I would be more inclined to think we're going to get a very dovish statement because once the Fed does cut, they do tend to continue to cut continually. And so I think that they're going to want to wait a little bit longer to see a little bit more weakness of the soft landing, more evidence thereof, because the last couple inflation prints and employment prints have not been consistent with the sort of dialogue of a shift towards the aggressive cuts that many bond market participants have been pricing in as recently as a week ago.
Okay, so it's a question of whether they got the ammunition to go early, and then they got politics getting in the way, haven't they? Gagi, let me bring it to you. Should they extend? Is it folly to go too early?
Good morning, Manus. It's great to be here. Thank you for having me. I think given the totality of the data, I'll use some of the Fed's language. I think for March, it does feel a little too early. While inflation is making meaningful progress, and the markets are very happy about that. And again, at the end of at the end of this week, we expect to see more progress on the PCE front. I still think that the Fed will give a nod to the fact that inflation, services inflation, is still sticky. March, in my opinion, a little too soon, but I do think they start soon thereafter, probably by the May meeting, and then get out to about 4 rate cuts for 2024.
Yeah, the magic PCE, the 3%. Will we break that level, and how much will we do that by? We'll come back to that in just a moment. And investors are bracing for the key U.S. GDP and PCE prints. The data will add to the debate over the Fed's next move, and that debate already playing out for central banks around the world. Mike McKee is with us now. Mike, a very good day to you. We've had policy on the move in Asia. Lay the table for me.
Well, we've had good news in the United States. We're expecting reasonably good news tomorrow. But in China, of course, the news has not been as good about the economy if you accept the fact that their numbers might not be right. So the People's Bank of China today announcing that they are, in a week, going to be cutting the reserve ratio, the amount of money banks have to keep on hand, and that, in theory, will add some liquidity to the overall markets. But there is general agreement among analysts that they're probably not going to get much from this, and they need to do more. So we'll keep an eye on China. Now, in Europe, we get an ECB meeting tomorrow. What's going to happen there? The betting is still that they don't cut rates, but look at what's happening with the economy. The numbers, except for the services PMI in the UK, everything's in the 40s, suggesting contraction, nothing getting better. It is still an economy in trouble. So what, if they don't do anything, do they say about when they might do something? That's kind of going to be the question of the day overall. Bank of Canada meets today, but they're not expected to do anything until April or June. The interest rate futures for the European Central Bank say the same thing. The Fed, right now, we priced out over the last couple of days the idea of a March cut. Suppose it could come back if the data are bad tomorrow, but the betting now is that we'll see it in May, and the Bank of England in June, although after the PMIs in the UK today showed prices rising again, inflation going up. There are questions about whether even that will happen, Manus.
Yeah, it's this magical glide path, isn't it, Mike? Thank you very much. Let's see what the GDP is. And, of course, we get a little bit of PMI here in the US in just under 40 minutes. We'll return to Mike for that. Gagi Chaudhry and Jack Caffrey are my guests this morning. Here's the thing. We've got this Goldilocks kind of scenario for equity investors. I read a wonderful note which said, don't get vertigo here. Stay fully locked, stay fully loaded, stay fully invested. Gagi, you're smiling, but you know what? That smile could be on the back of all of our faces by the end of the week. Do you get vertigo here cross assets?
Honestly, I think this is creating some immense opportunities in the marketplace. I'll start with fixed income because I think that's where the opportunities are absolutely fabulous. You have these yields, especially on the intermediate part of the curve. When you look at the all-in yields you're getting in the IG markets and the EM markets and the high-yield markets, I think that gives you some real opportunity to own quality assets. So I think that is one area where investors have already gravitated to for all of 2023, and I think that's certainly going to be the case in 2024 as well. We will look back at these yield levels at above 4% on 5- and 10-year treasuries, and we will have wished that we bought them. So if you're sitting on the sidelines with cash, I think you're supposed to step in. With equities, I mean, it's a little bit tougher to have as much conviction, but I think here again, high quality is the name of the game. Stay invested, absolutely, but stay up in quality and stay large cap despite the moves.
Yeah, well, that involves a little bit more deep dive into the balance sheets, maybe, of some of those corporates before you pick up the bonds. Jack, let me take it to you. Absolutely fabulous, to coin the phrase from Gagi. Absolutely fabulous opportunity in fixed income, high yield and IG. Concur?
Well, as an equity portfolio manager, I'm going to have to take the other side of that view. And I would certainly say, look, you know, S&P's up more than 2% month to date. It seems unlikely that we can compound at a 2% monthly rate for the rest of the year and put up another 25% year after the gains last year. Valuations are on the richer side, and that's with an expectation of 11% earnings growth. But at the same time, 11% earnings growth is pretty compelling. I do think that we can hold and see earnings drive gains for the year. I agree with Gargi that moving into higher quality equities makes a lot more sense rather than being a little bit too cute and trying to time whether a market's starting to get short-term vertigo or not. But I do think over time, you are well rewarded from not only being in growing earnings, but growing dividends and growing cash flows being returned to investors in other ways. And potentially seeing companies taking advantage of some of that pullback in yields. You certainly saw with mortgages, where mortgage rates have come down 1%, and purchase mortgage applications actually have started to improve again.
I'm building that FICO score as we speak. Don't worry, I've only touched on. I've only got 4 months data, so I can't get the mortgage just yet. And before we shift back to Gagi on the fixed income side, Jack, you would say that the earnings recession is over. You must be quite heartened. You see Netflix up 10% overnight. We're waiting for some of the bigger tech companies to come this evening in terms of Intel, etc. Your first takeaway in terms of the boost in the arm from tech overnight?
Well, you know, you certainly see that with the. In terms of, I would actually say there's a little bit of a mixed take on what you saw in some of the earnings last night. Netflix certainly posted, you know, much higher subscriber growth, which has investors excited. The idea that they're expanding their business has investors excited. But then you look at a company like Texas Instruments, which still can't get us to the idea that we've actually managed to clear all the inventory situation, and which they pointed to areas like industrials and autos. And that comes back to this ongoing disconnect, if you will, between a still pretty robust ISM in the United States for services, you know, comfortably above 50, and a manufacturing ISM slightly below 50, and where you have, again, an economy led by services. So that, I think, speaks to, the consumer has money, the consumer is willing to spend money, and that keeps things going. But you're not necessarily getting quite as much of the bang you would like on the more profitable corporate capital spending issues that Texas Instruments is highlighting in terms of some of those bigger ticket consumer items that might need some financing, like cars.
Yeah, but then you look at the ASML narrative in Europe, and they're talking about, a monster growth at the back end of the year. 2025 year will be another year of growth, and that's feeding the Chinese story. Gargi, let's just close it off with you. I'm fascinated. You say you favour adding a form of downside protection here. How?
Yeah, so a couple of things. I think, Jack mentioned this earlier, that we've had such a strong start to the year. We cannot possibly compound at this rate. There will be pullbacks in the equity markets. Now, you as an investor, if you've stayed in cash, should you continue to stay in cash? No, we think you should be invested. But protect your downside with buffered strategies. And that's a way for you to reduce the volatility in your portfolio, capture some of the upside in the equity markets, but also be protected. We like the moderate buffered, so up to 5% per quarter if you do have those pullbacks. I'd also say that, I'll reiterate that in a world where the Fed is poised to cut rates soon, we think in May or June, I think that is a period where intermediate duration fixed income up in quality, but also looking at actively managed ETFs like BINC, which give you that full yield in EM and high yield. We think that makes a lot of sense for investors. So protect your downside in equities and clip that coupon in fixed income.
There you go. That is the mantra of 2024. My favorite IB this morning is vol is cheap, making it compelling time to buy downside protection. Okay, team, stay with me. Gargi Chaudhry and Jack Caffrey on the markets. Joining me now side by side before the opening bell, it is Abigail Doolittle. Abigail, what have we got under the hood?
Well, we have some of these earnings movers that you all were just talking about. Let's start off with the shares of Netflix, which are popping sharply higher, up 10%. This, of course, on a solid beat of both top and bottom line estimates. But what has investors really wowed, as you were all just discussing, adding 13 million subscribers, a record fourth quarter, big growth there. New programming and the password crackdown continuing to help. Tesla up 1.5% before reporting its quarter after the bell. Profits expected to fall 39% year over year. On the other hand, revenues are expected to grow 6.4%, perhaps reflecting the price cuts that have happened over the last year or so. And investors will be looking to see whether or not they talk about 2.2 million deliveries on the year. And then finally, a big laggard, DuPont plunging down 13%, heading to its worst day since March of 2020. They pre-announced to the downside ahead of their February 7th quarter. They're talking about the first quarter being weaker than expected, citing China weakness. Investors not liking that. Again, the shares of DuPont down 13%, going in the opposite direction of the futures.
Okay, nice wrap up there, Abby, ahead of the opening bell. Coming up, despite losing New Hampshire, the Republican hopeful Nikki Haley is not losing hope.
This race is far from over. There are dozens of states left to go.
We head to the Granite State next for the very latest on the GOP race, right here on Bloomberg.
Over. There are dozens of states left to go. And the next one is my sweet state of South Carolina.
And we're off to South Carolina. President Trump taking New Hampshire by a double-digit margin over the former UN ambassador Nikki Haley. South Carolina is the next Republican presidential primary coming up on February 24th. It is just 1 month from today. We're counting down. The latest polling, this is what we've got. Real Clear Politics showing Trump with a 30-point lead over Haley, and this is her home state. Joining us now from New Hampshire, it is Bloomberg's Katie Lyons. You must be shattered, but let's give it another stab today. Here we go. Trump took over 50%, Haley 44%. Do you think she's going to stick in there all the way, Kaylee? Give us your take.
Well, Manus, that's what she says. She says she's taking this to her sweet home state of South Carolina 4 weeks from now, and potentially she could take it beyond that to Super Tuesday. Her campaign certainly has the resources. In fact, she raised $1.5 million in the 2 days following Ron DeSantis' dropout of this presidential race earlier this week. So she does have resources. There is going to be a big donor event for her where you are in New York just 6 days from now on the 30th, hosted by the likes of Ken Langone and Stanley Druckenmiller. But it's going to be a question of whether or not the donor money stays with her, given that she did get defeated by Trump here in New Hampshire, a state heavily populated with moderate Republicans and independent voters, by a margin of 11 points, potentially not that strong second place showing that she and her supporters were talking about here in the Granite State. And the contest is going to get much more difficult for her going forward, especially with the Trump MAGA base potentially mobilizing against her. And she could face growing calls from within the establishment of the Republican Party to fall in line behind Donald Trump as the Republican nominee, as so many others have, Ron DeSantis, Vivek Ramaswamy, and South Carolina Senator Tim Scott included, all candidates who were candidates up until just recently. Something else I would note, though, is a memo her campaign sent out yesterday noting that on Super Tuesday, March 5th, 11 of the 16 states there have open or semi-open primaries. The thinking being she could still attract those independent, potentially former Democratic voters in those states and help up her delegate count. The thing is, though, if she couldn't do it here in New Hampshire, very hard to see how she's going to be able to do it moving forward. This is a very steep hill for her to climb, which is why this morning many people are saying that actually the general election, frankly, has already begun, that what we're heading for is a rematch between former President Trump and the incumbent President Joe Biden. It is a rematch that 70% of voters say they don't want, but very much seems like it is what they're going to get, Manus.
Well, the population sometimes don't get the real choice that they want. Kayleigh, thank you very much. Kayleigh Lyons, tracking the political jamboree around America. Gagi Chowdhury, Jack Caffrey are my guests this morning. Gagi, let me bring it to you first of all. Look, this is a back-to-back win for Trump. We don't know what happens in the next 30 days, but let's just run the assumption is that he takes the nomination. Now, we know that this is a tariff-orientated, tax-cutting-orientated, America-first-orientated narrative, and that could stretch for longer and larger than the previous campaigns that we've seen before. The impact, if at all, various people have said to me, don't bet on either candidates, just get on with your strategy. To you, when you see this kind of coalescing around Trump, what does it do? What are the questions that come up in your mind?
Sure. So I think what I focus on, what the team and I focus on, is historically what have political periods and election periods meant for markets? How have investors responded? And of course, every election cycle is different. And I think what we need to focus on also is the backdrop of cash that's on the sidelines. So when you take all of that into consideration, what we have found is the 3 quarters that lead up to the election, there is a lot of volatility in the markets. People are a little bit more cautious and nervous about the markets. And of course, once you get that certainty, post-elections, the 4Q is often the best for markets on election years. So I would imagine looking at this historical period, again, there's still a long time to go. November's far away. We're also in a Fed cycle. We're also in a global central bank cycle. There is so many things that's going to drive markets. I don't want us and other investors and listeners to get caught up by just this one narrative. Let's think about what else is moving in the markets. I do believe, though, that investors here are supposed to focus a little bit on up in quality and providing for protection in their portfolios. And then, like I had said before, accepting the opportunity in the fixed income markets.
And Jack, you know, I think that's a very interesting point that Gagi makes. Goldman's have a note out this morning. They say actually it's going to be much more of a Trump would have a bigger impact on Europe and on the China and that correlation coefficient between China and Europe perhaps than it would here in the United States of America. For you, this is just going to be the start of what? A bumpier road in terms of the news cycle, but equity markets and bond markets, etc., just see through that.
You know, I think on one hand, as Kayleigh mentioned, you effectively have now a national campaign, or a national campaign becomes much clearer much more quickly than you might have had in more contested primaries in prior years. And I think that takes out some of the volatility that Gargi was mentioning that tends to dominate early in an election year as you try to understand what likely policies might look like. I think the challenge or the opportunity in this case is we pretty much know what the Biden administration wants. It would be more a continuity of current economic programs and current beliefs. The Trump administration or the former Trump administration has certainly been talking about what it might like to do when it returns to power. And I think there's probably a little less difference in terms of some of the underpinning economic beliefs of both major candidates in terms of wanting to see more manufacturing in the United States, trying to see more reliance on tariffs, both of which might wind up actually creating more of the inflation that has made the average voter so unhappy in terms of the backdrop under which they operate, and which is sort of contrary to much of the narrative that we keep talking about in the financial markets. And I think that actually might make for an electorate that winds up breaking quite late. As I was watching coverage last night, you were having voter after voter going and saying, I decided on my primary vote on my way to the high school gym to cast my ballot, or I decided in the last 24 hours. And I think that's going to make for a much noisier year, probably later in the year than we've had in the past, when you had greater certainty on which way people were likely to vote, and we had more confidence in the polls.
Okay, Gagi, I just want to close off. We're going into GDP, we're going into PCE over the next 24 hours. How important is it for you and the team that you see prints at 3 or sub 3% on the PCE to close?
I think it is very important for us to see the continued deceleration on PCE. I think GDP less so. I think the expectation is that we're going to meaningfully decline from Q3 levels. Now, whether it's 1.7, 1.6 is less relevant. I think PCE extremely important. 6-month annualized, as we've talked about, is already back below that 2% level. We want to see it sort of maintain that sub 2% level. I think we need to take our cues from what Governor Waller said. This is a Fed that's going to be extremely cautious. They're looking at inflation to be moving down credibly and sustainably. And I think another PCE print of 0.2 or thereabouts is going to show them that sustainable deceleration.
Okay, let's see what the prints are and how we react. Gagi Chaudhry and Jack Caffrey, my guests this morning on the markets. Coming up, you got your morning calls, and we're going to catch up with Mark Lehman of Citizens JMP Securities. His call on 2024, right here on Bloomberg. Towards the open, we've got a bifurcation in tech with Netflix bid up and Texas on the downside. Will we put another record high in? First up, let me get you some of your morning calls. Micro devices getting upgraded by the street. Research to a buy on potential of, guess what? AI chips. The analyst says AMD is the most attractively valued. Next up, Stellantis is cut to a hold by HSBC. The analyst citing declining market share, high inventories, and challenges to the car maker. Finally, Netflix is downgraded by Deutsche Bank to hold. The analyst says the streaming giant's leadership position is fully priced in the stock. Rocking it out, up 10% there. Coming up, Mark Lehman at Citizens JMP Securities. Let's see what he makes of Netflix. Direct lending's on fire at the NYSE. We're going for a lit-up version on the S&P 500, rolling it over onto the cash market. Will it be day 4 of a rally? Tech is infused. It has Netflix bid up this morning, but Texas Instrument takes a little bit of a hit. So across the equity markets, we are bid up. Will it endure? Do you want to stay locked and loaded, or will you get a touch of vertigo at these record highs? Euro-dollar trades up 0.7%. That is based on the view the PMIs in Europe weren't fantastic, but they were inching higher than when we estimated. That gives the ECB a little bit more time before they need to cut. The dollar's had its biggest drop of 2024, and that infuses the euro bid. The curve, the short end of the curve is down by 8 basis points, and treasuries are down by 4, as you can see. That also puts a little bit of pressure on the dollar and gives the euro a bid. Crude is up by 0.5% this morning. We've talked about it. Have you watched the Beckham feature on Netflix? That's the question for you. The streaming service reports the best customer gain since the early days of the pandemic. Abigail Doolittle can answer the Netflix conundrum.
Yeah, well, this is a big one, Manus, for sure. And it's one reason that we have this big rally for stocks on the day. Netflix itself up 9.3%, its best day since October of last year. And I gave you the incorrect information a moment ago. Because of this strength for Netflix, we're actually looking at a fifth up day for the S&P 500. You're only as good as your information, so I'm taking responsibility for that. Relative to the Netflix quarter, they put up strong numbers right across the board. They beat sales, earnings, but the big deal is the subscriber number that came in at above 13 million subscribers. Very similar to the pandemic type of numbers that they had seen when everybody was under lockdown and watching Netflix. It's a fourth quarter record. Operating income also tripled, almost tripled, I should say, to $1.5 billion from about $550 million a year ago. So tremendous strength there on the bottom line. Analysts had expected actually for subscriber growth to fall on the password crackdown, but it's done the opposite, it seems, as though people are willing to pay up to get their Netflix. The company is also talking about the idea that some of their own productions, such as Squid Game, that's really a positive. Analysts very positive. In fact, one analyst over at JP Morgan is saying that this is taking Netflix one step closer to global TV, although I thought we were global TV, Manus, so I guess there's a little bit of a competition there.
We are there. All hail the streamers. Abby, thank you very much. Let's stick with the earnings. Tesla reporting after the bell today, with the EV maker planning to start a new mass market electric car middle of 2025. That's according to Reuters. Ed Ludlow is with me from San Francisco. So BYD might be snapping at their heels and taking the crown in China, but it looks like we might get a new revamp lineup. Ed, good day.
Yeah, good morning, Manus. Look, it will come down to the basics of how many EVs does Tesla think it will build in 2024? The company has historically, well, going back to 2020, targeted 50% annual average growth on a compound basis. They built 1.8 million EVs last year, which, if you track that average annual growth on a compound basis, should see them say that they will build 2.5 million this year. The street says the guidance will likely be 2.2. That is the basics of it, but factor into the fourth quarter of last year some of the discounting and incentives that Tesla had to offer to shift vehicles in the final 3 months of the year, where in that quarter alone, you're right, it did lose the title of top EV seller to BYD in China. That will hit the bottom line. And so while it was a record quarter of sales in the quarter just gone, look at the bottom line where EPS is expected to drop around 38% year on year. Then there's all the awesome stuff. What are we going to learn about Cybertruck? What about humanoid robots like Optimus? And what about full self-driving beta? A new version was just released, and Musk posting in the last 24 hours, this might be the best version of that beta software yet. The retail traders really care about that. I know that I get excited talking about the sheer tech side of that story. The fundamentals for a car company are really important, but often when you think about the multiple this stock trades at, it's those kind of forward-looking AI-focused pieces of information that can be the catalyst going forward. And Elon Musk does tend to give big predictions on the earnings call, so tune in.
Yeah, well, that's what makes him sort of a go-to CEO for one-liners, isn't it? Ed, thank you very much. Tune in later on for analysis on what to expect. We've got Ben Callow of Baird joining me then. And a weak forecast at Texas Instruments, and this is the bifurcation in tech. The chip maker indicating a slump in demand isn't showing any signs of stopping. Simone Foxman is with me. Texas versus ASML. Simone, good morning.
Yeah, good morning. Bifurcation, the word that analysts are talking about this morning, too. Vital Knowledge talking about the bifurcation and how this Texas Instrument result clearly shows that chip makers for the data centers, the AI, they're all doing well. But those like Texas Instruments, which manufacture some of the most basic semiconductors, a big part of industry and autos, are challenged. Sales were light in the fourth quarter and no signs of them getting better soon. The chief executive officer, Haviv Ilan, said that in the fourth quarter, we experienced increasing weakness across industrial and a sequential decline in automotive. Revenue was down 13%. That was a miss. Sales, biggest contraction in more than a decade, and the forecast is poor. For the first quarter, looking at sales of 3.45 to 3.75 billion. The street had estimated over $4 billion in profit expectations, missing as well. The CFO telling Bloomberg in an interview, there's just been a different pace for different end markets. Auto demand, he said, is only just started to shrink, whereas that industrial demand has been doing so for a while, and so might be ending that sort of segment. Personal electronics has been a bit more stable. Again, as I said, Vital Knowledge talking about that bifurcation, the big word, and we're seeing those losses here. After, actually, we've seen a rally over the past couple of months, but not so much today. Manus.
Okay, nice context there, Simone. Thank you very much. And it's a mixed bag over at AT&T. You've got strong customer gains being overshadowed by the miss in terms of the outlook on the earnings. Isabel Lee is with the team. Isabel.
Hi, Manus. Mixed bag indeed. We have AT&T expecting an adjusted EPS of $2.25. That's lower than Wall Street's estimates of $2.44. But to your point, Wall Street didn't choose to focus on that. They chose to focus on that and instead not on the fact that the company posted a larger than expected increase in mobile phone subscribers. We have investors, including Vital Knowledge, saying that the knee-jerk reaction is not looking too good, especially after strong earnings from Verizon. But overall, the 2024 guidance isn't that bad. It's been a tough few months for AT&T. Shares are down around 10% in the past 12 months. The company has been dealing with heavy debt load and potentially high cost of cleaning lead out of its old copper phone networks. AT&T, now number 3 in the U.S., has fallen behind its peers Verizon and T-Mobile, especially when it comes to the development and the rollout of 5G and other next-generation networks. And under the new leadership, we've really seen some ruthless cost-cutting. The company has slashed employments, closed offices, and really sought to offload assets among the acquisitions it's done over the years. Manus.
Okay, Isabel, thank you very much. Let's begin our markets conversation with Mark Lehman of Citizens JMP Securities, weighing in on his outlook for 2024. This is where we jump up. If interest rates come down in the second half, we believe that could support the consumer confidence, resulting in a softer landing and improving trends across the consumer discretionary categories. So, Mark, there you go. We're all waiting to see whether the PC validates near-term rate cuts or back-ended rate cuts. But when I look at these markets, I'm just wondering, is the oxygen getting thinner at these highs? We're putting them in day by day at the moment. Or, as my last guess, we're very clear, remain invested. Do not get vertigo.
I think caution is always merited, but I think the backdrop continues to improve. And you're seeing some of the reports today validate that thesis, right? You have a backdrop where rates are coming down. I think optimism is increasing. We saw that in the Michigan Confidence Survey last week. And the companies are just leaner and better. And I think you're seeing some of that cost cutting and some of that improvement from the companies start to play out, and thus profitability will continue to increase, and thus that should support the multiples that we're starting to see these stocks lean into, which are a little higher, as we all know, than they were a year ago.
Yeah, I mean, they are just shy of where they were at their record high in valuation. But when it comes to technology, I mean, there's the bid and the offer overnight, isn't there? There's the bid on the Netflix, which is subscriber growth, to the offer, which is taxes, and so being hit a little bit there. When you look at tech, you talk about the advertising environment, and that makes you coalesce around Meta, but it also on the consumer side with regards to Dash.
I do. I mean, Meta, as we know, I say this all the time. 18 months ago, they changed their name to Meta, and they don't mention the metaverse anymore. So that shows the power of what they're creating and what the transformation that the company has had with what they have done with AI and what they're about to show. Back in the day when I started, these were years we started to talk about advertising. We started to talk about the election year. We started to talk about the Olympics, which are coming up this summer, and we pointed to winners when it related to that. Those are online winners. That's going to be Meta, which we all know is creating a very powerful engine with a far fewer number of employees. So it's a much more powerful profit backdrop. And then I look at DoorDash, a company that beat the last quarter substantially. And I think about their outperformance on the operating expense line and what's going to happen in this election year and again in this Olympic year. So I think there's ways to win for companies like that. Obviously, multiples are improving, so you got to make sure they're improving their profitability outlook. But I think both those companies are doing that handily and will do so throughout 2024.
Now, when it comes to margins, and this is something that we can debate, we've had greedflation, raising in prices above the price of inflation. So we've had that. We've had extraction of costs. 60 tech companies have let about 11,000 staff go so far since the start of the year. It's not monumental. It's not a huge number. But it is an indicator that margins, there's going to be a push to keep margins. Is that going to be through sustaining price rises or taking costs out of these businesses? What are you drawn towards?
I think the answer is both. I think about this all the time, but I think this AI revolution that we keep hearing about and we keep seeing fruits of is kind of Moore's Law 2.0 in a way, where, in the 90s, we had Moore's Law saying double your capacity at half the price. AI is showing the power of that kind of improvement in efficiency at breakneck speed. And if Meta, who's as good an arbiter of what those efficiencies are, is telling you that they have a 40% increase in their advertising efficiency, it's a metaphor for the entirety, I think, of technology. You look at SAP, which was a forgotten stock a year ago, and they talk about their job cuts today, which are not insubstantial. But you look at all the money that they're going to plow back into AI and the cloud. Those are rapidly efficient ways for them to gain profitability. And that's across the tech landscape. You talked about Texas Instruments earlier today, which is kind of a have-not right now. You look at the haves, whether it's NVIDIA or what we saw in ASM, there's definitely winners. This is not the market's crashing, so watch Texan and worry about it like you do today. It's more about who's the winner, because there's market share to be gained, and it's rapid, and that's what we're seeing in the market today.
Yeah, well, certainly, SAP cutting 8,000 jobs on a big restructure. But of course, what are they putting the money into? They're putting it into AI. So it's a transfer, perhaps not a major wholesale cutting that's going on there. Mark, thank you very much. Great context around AI and Moore's Law. Coming up, Tesla results, they're hitting the bell.
What's the roadmap, really, for inflating those margins in the medium term is what the market's really going to be really focused on.
That is, of course, after the bell. Left a word out. We'll get the analyst take next. That's Bird's Ben Callow joining me next on Bloomberg. Fresh data hitting the tape on the PMI, on the terminal. Mike McKee is side by side with me. It looks like a very comfortable set of beats. Mike, dig deeper.
Yeah, big difference between the United States and the rest of the world on these PMI numbers. Excuse me. U.S. manufacturing comes in at 50.3. It's the first time since earlier in 2023 in March that we saw a number over 50 signaling expansion, and it's the highest since October, I believe, of 2022. The services PMI comes in at 52.9. That is up from 51.4, and the global composite at 52.3 is up from 50.9. So strong beats on the U.S. Purchasing Managers Indexes, which completely are 180 degrees from what we saw out of Europe this morning. The Europeans pretty much all in the 40s, suggesting there is still contraction underway in manufacturing services and the composite indexes for most of their economies. One other headline, Manus, out just a moment ago. The Bank of Canada keeps its main interest rate at 5%. That was expected by everybody that Bloomberg Economics surveyed. Governor Tiff Macklem is saying that the path to the 2% target will be long and slow, and the question now becomes how long do they leave it at 5%, which is sort of an echo of what we're seeing in the United States these days.
Indeed, but those are bang-up strong numbers, Mike, in the United States of America. Mike McKee on the data. So Tesla reports after the close today. Deliveries and demand are going to be the focus for the EV maker. Bird's Ben Callow joins me now with a preview. You have an outperform rating on the stock. $300 is where you point to. Good to have you with me, Ben. I like how you encapsulate the situation here. We have had demand skepticism, we've had price cuts, we've had outages in Berlin, we've had multiple headwinds. But set the table for me. Demand skepticism will be defied?
Well, what we've seen so far this year, there have been price cuts across different geographies. And so, they are using price as a lever to increase demand. I do think the refresh of the Model 3 and the rumored refresh of the Model Y should also help with demand in this coming year. And I also think that the way that the credits work for the EV tax credits at the dealer at time of purchase should also help with demand as well. And then, as we look at numbers this year, Tesla in the past has talked about a 50% growth rate year over year on the long-term basis. Right now, we're at about a 16% growth rate. The street's somewhere just north of us. So numbers are tempered, and everyone's kind of bracing for a year of maybe weak demand. Now, looking forward into 25, we're getting news out that they're looking to have the Model 2, this is the mass market vehicle, come to market and start production sometime next year. And these are rumors from their suppliers. That could boost volumes considerably and be a big catalyst for the stock this year.
Tell me this, it's the perennial question. Is Tesla a battery technology company, an AI futurist company, or a car company?
Yes, it's all three of them. I think that, we've seen that it's an auto company. Energy should be a bright point of the business this quarter and definitely into 24, where it starts getting close to 10% of overall corporate revenue. And so that's showing itself as a real business too. AI is still out there. There's lots of skeptics, but I think this is the year where Tesla starts proving out that they do have the capabilities there. And, there's been the discussion around must pay package, which is important there, as well as they start, moving more into AI.
Well, pay matters. We've seen that in Banky, Jamie Dimon, along with the outgoing Morgan Stanley CEO. Ben, tell me this. I look at China. BYD takes the top spot in electric vehicles in China. We know the national story there. That's fine. But then you look at the data about the growth in EV in China, and this is what we got for you. EV growth is set to slow for the second year this year. It will grow 25%, 11 million units this year, but that's down from 36%, down from 96% in 2022. Is the trajectory for China and Tesla's position in China materially on a downward trajectory, or is it a temporary interruption, and how important is that?
Well, I think overall, we always look at competition as versus internal combustion engine as you take more share there. Headlines would say that no one's buying EVs, but we've seen growth across China, across North America, across Europe. Now, a slowing growth in China, that could be a concern. So far, we're still seeing strong numbers out of China. Still early in the year, though. I do think price cuts can help, and definitely that the Model 2 coming to market, I think propels growth. As we look into next year in China.
What is it that gets me to $300?
I think us seeing trough margins is one big thing. Us learning more about Model 2 and how far along Tesla is. And really what they've been doing is, to use Musk's phrase, building the machine that builds the machine. I think that they're nearing finalization of the line, the design of the line to build this Model 2. Hear more information about that would be a catalyst. And I think, getting up north of 300 is when you start talking about Optimus licensing full self-driving to others, using the Dojo computer for other industries, licensing that as well. And that's stuff that people are very skeptical about, but I think that can become a reality this year.
Okay. We'll keep an eye on that target. Ben, thank you very much. Let's see what the numbers deliver this evening. For some of the sector price action this morning, let's get across to Abigail Doolittle. Abby, what have we got?
Well, we have a pretty robust gain here today, Manus. We're looking at above average volume to the last 20 days. We have most of the sectors higher. And of course, we're looking at that fifth up day for the S&P 500 in a row, 4 record highs in a row, the first string of that since in about 2 years. Communication services, not surprisingly, leading the way, helped out by Netflix. Tech is also up there to the downside. Materials, as DuPont weighs on their negative pre-announcement, consumer staples, industrials. Let's dig deeper on that communication services sector, though, because it is part of the reason that we have the S&P 500 up over the last 5 days, gaining 5.9% over those last 5 days. Manus, that's the best stretch going back to November of last year.
Whoop, whoop. There we go. All hell. Stay fully invested. Don't get vertigo. That's the note from UBS. Abigail, thank you very much. Abigail Doolittle on the sectors coming up on the show. We'll give you the market moving events that you need to slate in your trading diary on Bloomberg. equity investors have not caught vertigo. We've still got rising markets. We're waiting for IBM and Tesla to deliver their numbers. If we stay in the green here, there's going to be the fourth day in a row of record highs. Do you want to stay fully invested? Let me give you your trading diary for this Wednesday. Tech earnings continue. Tesla, IBM reporting after the closing bell. Thursday gets set for another central bank. The ECB delivers their decision. Christine Lagarde will guide you through the press conference. And the US strong GDP figures. Is that what we will get? Friday gives you the Amex reports. Have you been spending? And of course, the US PCE print ahead of the Fed's decision next week. That needs to come in at or better than 3% to maintain your investment in investment-grade credit and high yield, according to BlackRock. That was the conversation this morning on Countdown to the Open. I'm Manus Cranny. This is Bloomberg.